You watch your account balance climb. You add more size. You're confident now. The setup looks perfect. You enter with twice your usual risk. The trade turns against you. You freeze. You hold. You tell yourself it will come back. It doesn't. You exit at a loss that wipes out days of careful gains. You sit there staring at the screen, wondering why you always do this, why the trades that felt most certain are the ones that hurt the most, why the moment you try to win big, you lose bigger. Most people think this is about greed or lack of discipline or poor risk management, but it's not. It's about something deeper, something wired into how your brain processes threat and reward when the stakes change. And until you understand that mechanism, you'll keep repeating the same cycle. Small wins, confidence, bigger bets, bigger losses, reset. The market doesn't punish you for trading. It punishes you for trading differently when you think you've figured it out. This isn't a strategy problem. It's a nervous system problem. Your brain doesn't evaluate risk the way a spreadsheet does. When you risk $50, your prefrontal cortex stays online. You can think, you can wait, you can follow your plan. But when you risk $500, something shifts. The amygdala lights up. The part of your brain responsible for survival takes over, and suddenly you're not trading a setup, you're fighting for your life. Every moment of drawdown feels like danger. Every moment of drawdown feels like loss. Your body floods with cortisol. Your decision-making narrows. You can't see the probabilities anymore. You can only see the pain. This is the mechanism nobody talks about, the transition point where rational analysis becomes emotional reaction. It's not the same threshold for everyone. For some traders, it happens at $100 of risk. For others, it's $10,000. But everyone has a number. A point where the risk becomes real enough that your body responds as if something is being taken from you right now, not in some theoretical future, right now. And once that switch flips, you're no longer executing a trading plan, you're executing a survival plan. And survival plans in the context of probability-based games are almost always wrong. This is why the trader who risks 1% per trade often outperforms the one who risks 5%, not because they're more conservative, but because they stay calm. Their brain never switches into threat mode. They can execute the same way on trade 50 as they did on trade 1. There's no emotional escalation, no performance anxiety, no choking under pressure. They're not trying to win, they're just repeating a process. And over time, that repetition compounds in ways that volatility never can. Think about how you feel when you trade at different sizes. Really think about it. When you trade small, there's a lightness to it. You can be curious. You can wonder what the market will do. You can test ideas. You can take a loss and immediately think about the next setup. Your attention is on the pattern, not the outcome. But when you trade big, everything changes. Your jaw clenches, your shoulders tighten, you check the position every few minutes, you imagine what you'll do with the profit or how you'll explain the loss. You've left the realm of exploration and entered the realm of consequence. And consequence, especially feared consequence, destroys the very skills you need to navigate uncertainty. Let me show you two traders. Both have the same strategy. Both have the same win rate, same risk-reward, same market conditions. The only difference is position size. Trader A risks 2% per trade. When he's up 3 trades in a row, he feels good. He starts to think he's in a hot streak. He bumps his risk to 3%, then 4%. He tells himself he's being aggressive, not reckless. The next trade loses. It stings, but he stays at 4% because he wants to recover faster. 2 more losses. Now he's down 8% in 3 trades. He feels the pressure. His chest tightens when he opens a position. He starts second-guessing his entries. He exits early on a winner because he's scared it will reverse. He holds too long on a loser because he can't accept another hit. Within 2 weeks, his execution has completely degraded. He's still using the same strategy, but he's no longer the same trader.
He starts each morning reviewing his losses, trying to figure out what he did wrong. But the answer isn't in the charts, it's in the size. His nervous system has been hijacked. He's trading from a deficit now, not a financial deficit, an emotional one. Every trade feels like it needs to fix something, recover something, prove something. He's no longer sampling probabilities, he's gambling on redemption. And the market doesn't care about redemption. It just continues doing what it always does, indifferent to his internal narrative. Trader B risks 0.5% per trade. She has the same 3 wins. She feels good, but nothing changes. She takes the next trade at 0.5%. It loses. She doesn't feel much. She takes another, loses again, still fine. She's down 1.5% after 5 trades. Her body hasn't registered this as danger. She keeps executing. She gets 2 more wins, then a loss, then 3 more wins. Her equity curve moves slowly, but it moves in one direction. She never has a day that feels like catastrophe. She never has a loss that forces her to take a break. She just keeps trading. 6 months later, she's up 18%. Trader A is down 4%. But something else has happened. Trader B has taken 300 trades in that time. Trader A has taken 90. She's seen more setups, adapted to more conditions, built more pattern recognition. Her edge has sharpened through pure repetition, while his has dulled through emotional interference. She's developing skill, he's developing scar tissue, and scar tissue in trading shows up as hesitation, as second-guessing, as the voice that says, maybe I should wait for a better setup, when the setup is already there. Same edge, different outcome. The difference wasn't in the market, it was in the space between stimulus and response. When position size is small, you preserve optionality. You can take the next trade without emotional baggage. You can lose 5 times in a row and still think clearly. You don't need to be right, you just need to keep playing. But when position size is large, every trade carries weight. You start trading outcomes instead of probabilities. You start hoping instead of executing. And hope is where consistency dies.
Hope is an interesting emotion in trading. It feels productive. It feels like you're staying positive. But hope only shows up when you're attached to a specific outcome, when you need something to happen. And the moment you need something from the market, you've already lost your edge. Because your edge exists in the aggregate, in the 100 trades, in the 1,000 trades. But hope lives in the single trade, the one that's open right now, the one you're watching, the one you're negotiating with in your mind. Hope makes you hold losers. Hope makes you exit winners early. Hope turns a probability game into a prayer, and markets don't answer prayers. They answer consistency. There's a principle most people ignore. It's called emotional overhead. Every trade costs you something beyond money. It costs you attention. It costs you clarity. It costs you nervous system capacity. When you risk too much, the emotional cost exceeds the informational value of the trade. You stop learning. You stop adapting. You're just surviving. And survival mode doesn't produce good decisions. It produces reactive ones. Think of it like carrying weight. If you're carrying 10 pounds, you can walk for hours, you can notice things, you can adjust your pace, you can change direction easily. But if you're carrying 100 pounds, every step is effortful. You can't look around, you can't adapt, you're just focused on not collapsing. Trading with oversized positions is like carrying 100 pounds through a maze. You might have a map, you might know the way, but the weight makes you slow, makes you rigid, makes you unable to respond to what's actually happening in front of you. This is why professional traders often risk less than amateurs, not more. They understand that capital preservation isn't about protecting money, it's about protecting state of mind. They know that the trader who can take 100 trades without flinching will always outlast the one who swings for the fence and spends the next week recovering emotionally. Consistency isn't built on discipline, it's built on low friction, and friction increases exponentially with position size. The best traders have a word for this. They call it staying in flow.
But flow isn't a mystical state. It's just what happens when task difficulty matches skill level and emotional interference is minimized. When you trade too big, you artificially inflate task difficulty, not because the technical execution is harder, but because the emotional weight makes everything harder. You can't see setups clearly. You can't wait for confirmation. You can't let winners run. Every decision is clouded by the magnitude of what's at stake. You're no longer trading the chart. You're trading your fear of the chart. So, what does this look like in practice? You wake up. You don't check your account balance. You don't replay yesterday's trades. You open your charts. You follow your process. You see a setup. You risk the same amount you always risk, small enough that if it loses, you'll take the next trade without hesitation. You enter. You set your stop. You walk away. The trade plays out. You don't watch every tick. You don't refresh the platform. You let the market do what it does. If it wins, you feel pleased, not euphoric. If it loses, you feel neutral, not crushed. You close the platform, you go about your day. Tomorrow, you do the same thing, and the day after that, and the day after that. This rhythm doesn't look impressive on any single day, but it compounds in a way that emotional volatility never can, because you're not optimizing for the best trade, you're optimizing for the most trades taken in a neutral state. And neutral execution repeated over time beats perfect execution attempted once in a while. There's something that happens around trade number 50 when you're trading small, a shift. The trades start blending together. You stop remembering individual wins or losses. You start thinking in weeks, not days. You start seeing your equity curve as a line, not a series of events. This is when you know the behavior is integrating, when it stops being something you do and starts being something you are. You're not a person who trades anymore, you're a trader. And the difference is that traders don't need courage, they don't need motivation, they don't need to psych themselves up, they just trade. The same way a writer writes, the same way a runner runs. It's not an event, it's a rhythm. Most traders fail because they lack knowledge. They fail because they can't repeat what they know, and they can't repeat it because the size they trade creates emotional interference. Every trade becomes an event. Every loss becomes a referendum on their ability. They're not building a process, they're building a performance, and performance under pressure collapses. Performance is the enemy of consistency. Performance requires you to be on, to be sharp, to be confident, but markets don't care if you're having a good day. They don't wait for you to feel ready. A setup appears whether you're rested or tired, whether you're confident or doubtful, whether you're on a winning streak or a losing streak. And if your ability to execute depends on your emotional state, you're giving away edge to traders whose ability doesn't. The trader who needs to feel good to trade well will always underperform the trader who can trade the same regardless of how they feel. And the fastest way to decouple execution from emotion is to make the stakes small enough that emotion becomes irrelevant. When you ignore this and keep trading size that affects your breathing, you create a feedback loop. You win, you feel invincible. You increase size. You lose, you feel defeated. Either you shrink or you revenge trade. Either way, your behavior becomes reactive. Reactive traders don't follow plans, they follow feelings, and feelings in trading are lag indicators. By the time you feel fear, you've already made the mistake. By the time you feel greed, you've already overextended. The emotional signal arrives too late to be useful. It only distorts what happens next.
This is the trap. The trade happens in real time, but the emotion arrives after the fact and influences the next decision. So you're always trading based on outdated information. Your fear from the last losing trade makes you skip the next winning trade. Your euphoria from the last winning trade makes you overtrade into the next losing trade. You're out of sync. And being out of sync in a probability game means you're systematically making the wrong decisions at the wrong times. Not because you don't know better, but because your nervous system is operating on a delay. But when you trade small, something shifts. You stop performing, you start operating. The trade stops being about you. It's just data, a sample in a distribution, one event in 1,000. You don't need it to work. You don't need to prove anything. You just need to take it, manage it, and move on. And when you do that enough times, the behavior becomes automatic. You don't think about position size anymore. You don't think about whether you're being too cautious. You just trade, the same way you breathe, without effort, without commentary. It's no longer something you do, it's something you are. This is where the real edge lives, not in finding better setups, not in better indicators, not in better timing. The edge is in becoming the kind of person who can execute the same way 1,000 times, who doesn't need the market to validate them, who doesn't need a big win to feel successful, who can lose 7 times in a row and take the 8th trade with the same calm intention as the first. That trader is rare, not because the skill is difficult, but because most people never lower the stakes enough to develop it. This is where most people misunderstand the goal. They think trading small is a limitation, a stepping stone until they can handle bigger size, but it's not. Trading small is the advantage. It's the thing that lets you stay in the game long enough to get good. It's the thing that lets you take enough samples to trust your edge. It's the thing that keeps your nervous system quiet while your skill develops. The best traders aren't the ones who learned to handle big size. They're the ones who never needed to. They understood early that size is a drug. It creates a high that feels like progress, feels like you're really doing something. But that high is a signal that you've crossed a threshold, that you're trading for stimulation, not for process. And stimulation seeking in trading is just another form of self-sabotage. It's the same impulse that makes gamblers increase their bets, not because the odds improved, but because the feeling demands it. And feelings, no matter how compelling, are not strategies. If you've been trading too big and feeling the weight of every position, try this. Cut your size in half, not temporarily, permanently. See what happens to your execution. See if you start checking your account every hour. See if you sleep better. You're not giving up profit. You're giving up the emotional tax that's been eroding your profit all along. And once that tax is gone, you'll realize the edge was always there. You were just too stressed to execute it. You might notice something else too. When the pressure drops, curiosity returns. You start asking better questions. You start noticing patterns you missed before. You start testing ideas without fear of catastrophic loss. You become a student again instead of a survivor. And students improve. Survivors just endure. The market will teach you everything you need to know if you can stay calm enough to listen. But you can't listen when you're drowning. And trading size that scares you is drowning. It's just slow enough that you don't realize it until you're under.